Have you ever wondered about the differences between mutual funds and ETFs? Aren't they kind of the same thing? Or are they very, very different? And if they are different, which one is better for your portfolio? Fasten your seatbelts, folks. This is going to be a good one. Both mutual funds and ETFs, or exchange-traded funds, are ways to bundle stocks in a managed fund that can promote diversification while requiring next to no work from you. That doesn't sound too bad at all. However, that is also kind of where the similarities stop, as they are two very distinct financial instruments. How you buy and sell them, how they behave on the market, their fee structure, and even tax implications can be very different. We will be breaking all of that down in a moment. But before we do, I did want to talk about index funds. What is an index fund? Very simply, it is any fund that tracks a specific index, hence the name. For example, if an ETF or a mutual fund invested in stocks from the NASDAQ 100, that is a specific index, and thus you can call either the ETF or the mutual fund an index fund. Join today's conversation. Let me know in the comments if you prefer ETFs or mutual funds. Thank you for your participation. If you love this sort of content, be sure to subscribe for more, and another huge thank you for that click. Let's get into the nitty-gritty. The buying and selling of mutual funds is completely different than how we do it with ETFs. So for a mutual fund, they're usually purchased from the fund company or through a broker. The price of that mutual fund is their net asset value, or NAV, which you also see with ETFs, although with ETFs, their price and NAV can be different. No such difference exists with mutual funds, and they are bought and sold at their NAV price. The mutual fund NAV price, that's calculated only once a day, at the end of the trading day to be precise. You also would place your orders to buy and sell at the end of the day as well. If you placed an order earlier, it would not get processed until, well, the end of the day. Confirmations of that sale will then be sent out to you the next day with the details of how many shares you bought and at what NAV price. Of course, ETFs do not have to wait until the end of the day, as you can buy and sell them throughout the day just as you can with regular stocks. They do have an NAV, which is updated at the end of each trading day, just like a mutual fund, but they also have a price which can vary somewhat from their NAV price. That price that moves throughout the day, it's actually called an INAV, so INAV, or intraday net asset value. Moving on to market behavior, it kind of ties right back to how we buy and sell. With a mutual fund, where the price is only updated at the market close, we will only have one data point to work with each day. This can certainly make a shorter-term technical analysis very unreliable. In fact, as you'll see in a little bit, mutual funds are almost designed to discourage short-term trading. Of course, with an ETF, we have all the data points, so charting them is no different than charting any other stock on the market. This makes them a little easier to work with for the shorter-term traders. Thus, it is possible to day trade or swing trade an ETF if you so desire. Another very important area of difference is in their fee structures. Mutual funds, hands down, have more fees than your typical ETF. Some of these fees include sales load fees, which can come in the form of front-end or back-end load fees, which are essentially fees for buying and fees for selling your mutual fund. Expense ratio fees. These, of course, include their management and administrative fees, as well as a fee called 12B-1. That's a fee that covers marketing and distribution expenses, as well as commissions to brokers. Account fees can be charged for maintaining your account, though they may be waived if you maintain a specific account balance. A redemption fee is a charge for selling your mutual fund before a specified time frame. It is a way to, if you remember what I was saying, discourage those short-term traders. You can also see an exchange fee, which can be charged for transferring or exchanging one mutual fund for another. In other words, with a mutual fund, you really want to be in for longer terms for sure. There is also a purchase fee, which is very much like that load fee I mentioned earlier, but it's paid instead to the fund opposed to the salesperson. There can also be, in some cases, legal fees, audit fees, custodian fees, and transfer agent fees. That sure is a lot of fees. To be fair, not all mutual funds charge all of these fees, so you definitely want to be aware of what fees you're going to get hit with when you decide to invest in a mutual fund. As I said, that sure is a lot of fees. Let's take a look at the fees associated with an ETF. So, with ETFs, you have the following fees. You have have a management fee, which is basically the fee paid to the fund manager for managing the investments. You also have a management expense ratio, or MER. Now that includes annual operating and administrative charges, and it also includes the management fee as well. You can also run into commission fees. Now that, of course, is charged by your broker. So if you do have a commission-free broker or an ETF commission-free trading platform, you don't have to worry so much about those. Okay, so let's boil this all down. So the average total fees for a mutual fund, well, that works out to approximately 1.01%, while the average fees for an ETF, that boils down to 0.50%. This means that on average, an ETF costs half as much as a mutual fund in terms of fees. This difference in fees can significantly impact the long-term returns of an investment, as higher fees can eat into your returns over time. However, it is worth noting that there can be a wide range of fees for both mutual funds and ETFs. And, well, some mutual funds can have fees that are comparable to or even lower than those of ETFs, and some ETFs can have some very high fees as well. Finally, when it comes to taxes, mutual funds do tend to be much less tax efficient than ETFs. The reason for this is that they tend to generate more capital gains because often the funds will have to sell securities to meet investor redemptions, which triggers those capital gains, and those taxes are then passed on to you. With an ETF, you have full control over when you sell and generate capital gains. Thus, you can manage it much more efficiently. There are absolutely exceptions. There are some ETFs that do return capital gains to you. So in those cases, you're going to be paying on those. But the typical ETF, you usually don't have to worry about that at all. Of course, if you are holding either of these in a registered account, the tax implications become moot very fast. One final point that I want to make about mutual funds is that they are often sold by banks. And if you are working with a financial advisor that works for the bank, you need to take that into consideration, that their recommendations may just come with some sales pressure from higher up. Do your due diligence on the product, but in this case, also do it on the seller to make sure you are getting an unbiased evaluation. I did ask a question at the top of the video as to which is the better financial instrument. I think ETFs are just the better product, based mostly on the agility that comes with being able to trade them like a stock. And of course, the lower overall average fees is not a bad thing either. In addition to that, ETFs come in just so many shapes and sizes that it really gives the investor a lot of choice to cater their portfolio exactly how they want it. From income ETFs to growth and total return ETFs to even sector-specific ETFs, they've got you covered. There is just so much you can do to customize your investment journey. Mutual funds, well, unfortunately, they just don't have you covered as well. Let's continue that learning journey. Check out this video on high income ETFs, and I'll see you in the next video.